Good morning. David Dietze here with Donna St.Amant. We welcome you to the latest edition of our monthly webinar. We're pretty excited to give this for a couple of reasons. One is, I'm not sure we could have had a more timely topic, which is going to be on COVID-19 in your portfolio. We're also kind of excited because we've never had such a large audience. Our hardworking, tireless assistant Marcela Garcia says we are approaching 100 people that have signed up to hear us talk. I hope we are helpful to you. Before I turn it over to Donna to kick it off here a little bit, we do have a poll, as we normally do. You should be able to see it on the right portion of your screen. Basically, the poll question is, the Dow right now is at 20,000. Where's it going to be at the end of the year? And you've got four choices: up 10% or more, 0 to 10, down 0 to 10, or down 10% or more from this current 20,000 level. So we'll have a chance to hear your views on that. We'll certainly share the results. Now, before I turn over to Donna, let me just tell you a little bit about Donna. We are so lucky to have her. Donna has been in the financial services business for over 20 years. She holds undergraduate degrees from Villanova. We've all heard of Villanova, and an MBA, I believe, from Columbia. She's worked at all the big banks along the lines in so many various areas, and she is a veteran here at Point View, having been here for over 6 years. So with that, I'm going to turn the mic over to Donna to start the presentation.
Great, thank you, David. Okay. Just a quick overview for those who may not be familiar with our firm, Point View Wealth Management. We are a registered investment advisor based in Summit, New Jersey. We're part of PPAC Private, which is the wealth management division of PPAC Gladstone Bank, and we provide customized investment management and financial planning services, primarily using the individual stocks and bonds. We have a $500,000 relationship minimum and a 1% annual fee that includes all of those services. And we custody our assets at Fidelity. This is just a quick overview for those who may not be familiar. Oh, sorry. Got the next slide here. Just here are some points of national recognition that Point View has received. So on to our topic for today. It has been an incredibly challenging month. We are in a bear market that has come about with one of the most sudden drops we have seen. This chart is a chart of SPY, which is an exchange-traded fund that closely tracks the S&P 500 index over the past 12 months. Along the bottom, the chart shows the volume of trading for that same period. So although this drop has certainly been severe, we would note that it has not been as bad as some other market corrections. If you take a look here at the next slide, you can see the recent market decline compared to other market downturns. So this chart shows the percentage decline from the peak of the market to its low point. And realizing that we may not have hit the bottom yet in 2020, but however, you can still see that the 2008 financial crisis and the 2001 tech bubble declines were even more severe. Now, another issue we're facing is that other asset classes have also tumbled. On this chart, we see corporate bonds and commodities have also shown significant declines. The black and the gold lines show the performance of corporate bonds for the past year. The black line is investment grade corporate bonds, and the gold line is the high yield, the riskier high yield bond performance. So corporate bonds, unlike treasuries, typically do perform more in step with the stock market. This would be kind of expected due to their exposure to corporate credit. So as such, we do not view them as truly diversifying an equity portfolio. We would much prefer U.S. Treasuries and municipal bonds to provide diversification. And then, of course, you have oil represented by the blue line, which has been under tremendous pressure. There have been a few safe havens. So here we come back to Treasury bonds. The pinkish line, this shows long-term Treasury performance up almost 30%. The US dollar in black has rallied in the last couple of weeks, reflecting the world's demand for the dollar in times of stress. And then the blue and the gold lines are ETFs that represent gold. GLD closely matches the change in the price of spot gold, and GDX invests in shares of the largest gold mining companies from around the world. So GDX is a reflection of both the price of gold and the stock market, and as such is more volatile. So it will outperform gold in the up markets and underperform gold in the down markets. So the big question, what are the steps that investors should be taking at this point? So we really want to assess your portfolio by reaffirming your asset allocation, particularly considering your time horizon. So your allocation should not be changed solely as a result of this market downturn. You want to stick with your equity target and rebalance. It's very important to remember your time horizon. So many don't need to take withdrawals at this time. So as painful as it is to see the value of your nest egg drop, unless you're liquidating your entire portfolio, it's not the end of the line. All major market downturns have rebounded. Now, if you are among those that are in retirement and you are taking withdrawals from your portfolio, consider that if you're taking a 4% withdrawal and your portfolio is invested 60% in stocks and 40% in bonds, that provides for 10 years of withdrawals from your portfolio, and you would not even have to touch your stock investments. So it provides plenty of time for recovery. But rebalancing at this stage means you're going to be adding to equity. This can be difficult to do emotionally. Many great companies that are less impacted by the virus are down with the overall market, presenting good buying opportunities. So in fact, if you have the discipline to rebalance and bring your equity exposure back up to your intended allocation, this positions you to gain the most when the market does rebound. This chart here provides a visual. You can see the tremendous recovery that took place after the 08 and 09 financial crisis. So until the market feels some confidence around containment of the virus by way of reduction in number of cases, progress in terms of treatment and a vaccine, it's unlikely that the market's going to stabilize. So you do have to realize, you may be rebalancing and adding, and we still expect more volatility to come, but it will pass. Take a look here. If you consider past health scares, the market has been up within 1 year after the scare. Yes, there is uncertainty, and no one knows for sure how this will go. But if you consider past crises that we have faced, the odds are we'll get through this. So I just want to turn it over to David. If you have anything to add here, or David's going to pick it up from here.
Yeah, thank you so much, Donna. Really set the table well. We have done that research, as Donna pointed out, and looked at over the last century all the different types of health crises we've had. And you can see you got the Asian, the Spanish, the swine, and of course a lot of non-virus things that have affected this country: smallpox, yellow fever, cholera, scarlet, typhoid, you name it. and been scratching our heads here and saying, would we rather have the coronavirus or one of those? Well, we'd rather have neither, but some of those have been far harsher in terms of mortality rates, in terms of damage than the coronavirus. But the point is that this country has powered through all of that. And there's no medical expert today saying we're not going to get past this. So, what are some of the other reasons for a little bit of optimism here? One would be that we are starting to see some signs of abatement in China and Korea. Indeed, the lockdown that occurred in the province that was the epicenter of this, Wuhan in China, has already said the quarantine can end. And we were heartened this morning when we heard that for the second day in a row, there were less new cases and less new mortalities in the northern part of Italy, which had been one of the hardest hit countries out there. Obviously, that does not mean we're out of the woods. China itself is, of course, very nervous about re-importing the virus from anyone coming into the country. But nevertheless, looking at China, looking at Italy could give us some sense that, yeah, indeed, there is light at the end of the tunnel. Experts have been looking at China and saying, about 3.5 months, where we will see the cases abate. So that's something to keep in mind. Of course, the United States is a very big country, so that you could have different regions of this country in different stages of peaking and then abating. So this is something we're going to be watching very closely here. A lot of people, they'll call us up on the phone. Did you hear this person on TV say this? This person said we're not going to have anything for the rest of 2020 and so forth. And, a lot of times when you hear that, obviously you want to take in all the information you can, but two things to ask yourself. This person is now an expert. Where were they on January 1? Were they talking about this or were they talking about something else? And invariably you find this person 2 or 3 months ago didn't even know what coronavirus was, and now all of a sudden they're an expert and can give you all the exact details as to how long it's going to be and how fearful you should be. Take that with a grain of salt. And then the other thing you could ask is, well, over the last 10 years, what was the track record of that pundit? Somehow those things all get kind of buried. So take everything you're hearing with a little grain of salt and ask those questions. One thing that is helping offset this pain, and remember, this is primarily a health crisis. It's not, unlike in 2008, 2009, a financial crisis. The financial issues are symptoms of the underlying problem. But nevertheless, there are things going on in the economy that are going to help mitigate some of the fallout. What are those? One is lower interest rates. It's probably the two most important numbers in the economy is what do you pay on your mortgage or a refi or a home equity loan, and what do you pay when you fill up the tank at the pump? So in terms of interest rates, they have fallen precipitously. For example, the 30-year Treasury has fallen from 2.4 into 1.5 approximately. So that's going to bring down mortgage rates, allow people to buy homes more cheaply. Why more cheaply? Because basically when people buy a home, it's not what the home costs, it's what's their monthly payment. If the interest rate is significantly lower like it is now, they're going to be paying a lot less. They can also do refinancing, and that's going to be more attractively priced. And now we're reading here that some people at the pump in the middle part of the country are paying under $1 per gallon. And for a lot of people in this country, that gives them extra money in the pocket. And finally, what's going on here is keeping inflation at bay. Another thing that gives people hope in terms of the stock market is many people, they look at, well, what's the yield that I can get on a treasury bond and what's the yield on the market? Well, now that the 10-year treasury, which they often compare it to, is yielding well under 1%, about 0.8%, and the Dow Jones Industrial Average is yielding 2.5, almost 3 times more income, people wonder, where am I going to be over the next 10 years? If I'm starting with 3 times the income and doing that over 10 years, it looks like a better bet in stocks. But it gets better than that because historically, over the long haul, U.S. corporations have increased those dividends anywhere from 3 to 12% per year. So maybe you're getting 2.5% on your money today. After 10 years on initial investment, you could be getting 5% or more. that certainly puts the odds in your favor that diversified investments in the stock market over the long haul could do better than the 10-year Treasury. The other thing that people who are investing the money have to realize that although the only true people who can resolve this problem wear white smocks and are in research labs trying to develop vaccines or are developing test kits, the government and policymakers, not just in this country, but worldwide, are doing all they can to pull out all the stops to bolster the economy. We have seen our Federal Reserve say they will buy debt assets almost without limitations. And we saw that yesterday. One of the reasons we have a strong market today is because the Federal Reserve, instead of just buying so-called agency bonds or treasury bonds, they went out and bought exchange trade funds holding investment grade corporate bonds. So they're going into the private sector. So they're doing everything possible. Of course, we've already seen 2 rate cuts from them, essentially taking down the federal funds rate, which is the key rate that banks use to lend to one another, and from the Federal Reserve down to between 0 and 25 basis points. But of course, it's not just the Federal Reserve. As we speak, Congress is trying to come up with a stimulus package, which will put hands into workers and the American people, plus provide resources for corporations, help them backstop loans and so forth. That's going to be big. Now, right now, apparently there's some dispute between whether you favor corporations or whether you favor employees. So, how do you split that pie? You know what's going to happen, since no one's concerned about the deficit or debt anymore. Don't just try and split a pie, just have 2 pies, 3 pies, 4 pies. By the time this is all over, you're going to be seeing a lot of pies helping everyone in the economy, and that's going to be a positive. The funny thing about investing is the things that really bite you are the things that no one are talking about. The black swans, the tail risks, things that have a very low probability thing of happening. But if they happen, since no one was focusing on it, it can really make stocks very volatile. And of course, that's what happened here. The problem now is, of course, or the good news, I suppose, is that at this point, everyone knows about the coronavirus, COVID-19, and arguably stock prices now reflect that, which means, sure, stock prices can go down further, but not just because of COVID-19, only if COVID-19 is much worse than the current dire predictions. And even if we have a continuation, and we will, of course, of the virus and the fallout, if it's a little better than people are worrying about, stock prices can move up higher. So focus on stuff no one's talking about, and you have some comfort that what people are talking about is already reflected and discounted in stock prices. Caveats. We've tried to give you some of the pros for being in the stock market despite this dire news about COVID-19. But the fact of the matter is, one must keep their seatbelts fastened and take a very long-term view. Anything could happen. There's never a guarantee of what the market's going to do. But when you think about it, there's no guarantee on anything, including the purchasing value of dollars, the value of your home. Everything is a little bit uncertain. So investing is all about playing the odds and hedging your bets by having a diversified array of assets. Indeed, the response to this virus could actually be worse than the actual effect. You could liken it a little bit like to someone smelling smoke in a theater, mentioning to someone, and more people are trampled trying to get out the door than are actually coughing their heads off in the theater due to the smoke. And indeed, just in the last 24 hours, Washington is putting a different spin on this and saying they're afraid that the cure of a complete shutdown of the economy may be worse than the malady itself. And so that may give hope to some stock investors that there may be some balancing in terms of cost and benefits so that people are allowed to get out of their house and go about their business, live their life, yet still protect those who need to be protected. We talked about the central banks. We talked about what people in Congress and the White House can do. But ultimately, let's be clear here. This is a health problem, not a financial one. I really believe that there's two things investors should be looking for to resolve it from a health point of view. One is obviously a vaccine or a cure. A vaccine to immunize you from getting COVID-19, a cure to ameliorate the symptoms once you have it. That would be great. Scientists are incented and around the world working on that very problem. The other thing that investors should be looking for is cheap, quick testing. Analogize it a little bit to what the TSA has done in terms of making sure weapons are not brought aboard planes. They've designed a relatively painless, fast way to check people to see whether they're carrying any weapons and allow them to get on the plane. Then when you're on the plane, you know that people around you don't have a weapon. They need something like that so they can quickly scan you and determine, yeah, you're now certified, you are free from the virus, you can go about your business. That will help to convince Americans that it's safe to go about their lives. Everyone asks us, gee, is the bottom in? No one can call a bottom. No one calls the top. It's that old slogan. They never ring a bell at the top or at the bottom. So don't try and make short-term bets based on things that are inherently unknowable. No one can predict what tomorrow's news will take. Always incrementally move in or out of the market. Don't try and make a big splash on a bet that today is the right day. Election issues. Other things to be concerned about, of course, is the current occupant of the White House has built as part of his record on a strong economy and a strong stock market. At the height of the sell-off in these past couple of weeks, brought the stock market below where President Trump took office. So obviously, this makes somewhat uncertain as to the track record in terms of the market, in terms of the economy. So that injects some additional uncertainty for the markets, for investors. Both of an uncertainty is something that markets and investors do not like. So again, watch that situation carefully. Take a very long-term view. If you have a true long-term view, you're looking many elections ahead and not just any one that could cause volatility here due to the recent events. Other headwinds, of course, even when we resolve COVID-19, and let's hope we do sooner rather than later, there were some issues that were cropping up that investors had to deal with even before even before the COVID-19 came around. One is the slowness of the global economy. Japan was near recession. Germany was almost in recession. The Chinese economy is growing faster than any other economy, but that was slowing down too. Partly that was due to the trade issues. There are still some lingering tariffs around the world, including between the United States and China, and those things have not gone away either. So what's the bottom line? Donna had it right. If you're a long-term investor, you and are a diversified investor, which hopefully you all are, you have some stocks, you have some bonds, and some cash. Following the huge sell-off, your bonds are a much larger portion of your portfolio. They're arguably overpriced. Bond prices have shot up. Interest rates have come down. Stocks, meanwhile, we have no idea where they're close to their bottom, but they're certainly cheaper than where they were before. They're certainly a smaller portion of your portfolio. So job one is, if you are a long-term investor, sell the more overvalued asset class, in this case bonds, and buy the lesser valued asset class, which is now smaller, and bring it up to your preset target. That historically has been a way to sell high, buy low, and stay on track. Remember what Warren Buffett says, one of the most successful investors in the world. He said, be fearful when others are greedy, greedy when others are fearful. Right now, we certainly have a situation where many are fearful. Could they be more fearful? Again, no one rings a bell at the very top of fearfulness or not, but certainly this is a time when you perhaps want to be adding to your portfolio. The other thing to be careful of is trying to buy once you hear the good news. What could that be? The best news would be a vaccine has not only been developed, it works, and it's available to everyone today. That's not going to happen quickly, but what you can count on is that stock prices will start to move up before your website is telling you all that good news. People know in advance, people are tracking all sorts of things and are getting all sorts of phone calls from labs around the world. So expect that the stock prices will move before the reason for their movement is staring you in the face. Of course, as in any time when you're in the market, expect volatility. Even once we hear some definite good news, there's going to be people who are taking profits because they were overextended. The market will pull back. More people will come in. It's going to be a back and forth. So expect the volatility and setbacks. Finally, be realistic here. Control what you can control. Don't fret what you can't control. You can't control the market. You can't control the developments on the health front. What can you control? You can control your reaction to the news. Don't overreact. Take the long-term view. Take it with a grain of salt. Stay healthy. Control your spending if you're nervous. Control your tax bill. Those are things that are within your control and is probably a better use of your time. So we have taken the first 26 minutes here to review with you our take on the markets and how they're being affected by COVID-19 and possible strategies to take advantage of all this. What we want to do now is to take your questions. And let me see here. Let me find those questions. Donna? Where are the questions?
So under your chat, we have a question. We do have a question here. During the last month or so, to what extent and when and how have you put your clients' money into cash? So I could just speak briefly that that's not a typical stance that we would take. We don't like to see any money really in cash that's not needed in the near term, earning nothing in a portfolio. We prefer to at least have it invested in fixed income, but it's not something that we look to do is to move into cash, trying to get ahead of a market move. David, you want to add to that?
Well, I think that's right. The time to get conservative, of course, is when everyone has their rally caps on, is chortling how we're going to see Dow 40,000. That's the time when everyone, of course, is greedy, that you want to start pulling back. But certainly trying to put money into cash, here's the problem. It's essentially market timing. So what our modus operandi here is to prepare for volatility, not to try and predict it. What do I mean by that? If you have an asset allocation, that implies that you're not quite sure the future direction of the markets. If you were sure about the future direction of the markets, if you were bullish, you'd put 100% in stocks. If you were cautious, you'd put 100% in cash. No one does that. So to try and trade on the headlines is bad for two reasons. One, of course, is that implies that you've got that crystal ball as to what's going to happen. No one does. And of course, not only do you have to have the crystal ball as to when the negative news is going to arrive, but then you have to have the crystal ball as to when the negative news is over, and then get back into the market. Those two decisions are not easy. And so we don't advocate it, and that's not our modus operandi. Donna?
Question for you, David, here. How will the addition of $2 trillion of debt affect the economy?
Well, so, that's a great question, because we're sitting here with 30 trillion of debt by the government and deficits that have been running at about 1 trillion a year, and now they're only going up. So everyone has shaken their hands and said that is bad. And in theory, it is bad, but we have seen no signs of interest rates going up because there's a shortage of money to borrow because the government is crowding private borrowers out. Indeed, interest rates are at record lows here, with the 10-year Treasury, as alluded to, down below 1%. Second, of course, is that inflation could be a problem if the government just creates all this money and goes out buying things or handing it to others who will buy things. But again, inflation is very quiet. Indeed, it's below the Federal Reserve's target. So at this point, I think putting people back to work, preventing financial stress, preventing defaults is seen by policymakers as far more important than the amount of debt being put on the government's balance sheet, because they're not seeing any negative side effects. Donna?
Disease will go away, but what about long-term economic damage caused by people not working and small businesses going bankrupt? I think we definitely are going to have to deal with the economic slowdown. The question is, have the stocks overreacted? And once, even if there is an economic slowdown, if it's not as bad as expected, you still may see recovery from the stock market. Any more to add there?
Yeah, I mean, basically, bear markets have been a feature of American financial history, for that matter, global financial history for the last 100 years. They come and go. And of course, we've had various wars, Vietnam War, Gulf War I, Gulf War II. All these things have taken a toll. But what we are seeing is the resilience of the American economy, where it does bounce back. Another positive in this situation is that we went into this travail in a very strong position with a positive GDP, with corporate earnings growing, and the jobless rate was close to a 50-year low. That would suggest that the damage may be a little bit less than people are worried about, and we can rebound much more quickly. Donna?
In a self-directed account, such as one with Merrill Edge, if you sell a stock, when does that money become available to buy another stock? Typically, the money is, you can buy another stock right away. Not 100% sure about Merrill, we use Fidelity, but the way it works in most cases, you can sell the stock, you cannot withdraw that cash until the stocks settle, but the brokerage firm will allow you to buy additional stocks based on those sales.
So another great question is the impact of the low interest rates on the housing market, given the general nervousness and fear as to people's finances, given this economic volatility here. Well, it's a great question. So certainly, all things being equal, uncertainty as to the outlook for your job, uncertainty as to the outlook for bonuses and promotions, seeing a volatile level in your savings, whether it's stocks or otherwise, that's all negatives. But what the Federal Reserve has done here is to try and offset that by lowering interest rates dramatically. So that the question is, would you like to have a big bonus and pay 5% mortgage, or have a jittery bonus with a 3% mortgage? I think actually most people would prefer to have the solid bonus and pay a little bit more, but the fact of the matter is, having those lower interest rates will help offset the pain. It's not a cure-all. There's that expression called pushing on the string, where the Federal Reserve can make money very, very cheap. But if everyone's afraid to borrow, whether that's to buy a home, a second home, to start a business, have some sort of capital expenditure, then they don't care how cheap it is. And that's where fiscal policy, where the government goes out, puts people to work, spends a lot of money, can be so good to help backstop and be a great accompaniment to strong fiscal stimulus. Donna?
We have a lot of oil stocks in the portfolio. Should they be sold and into other stocks that have been beaten down, but will rebound better than oil? Can you take that one?
Sure. So obviously, diversification is always job one. No one really knows what sector will come out of this in the strongest position. Some people say, well, the stocks that seem to have, quote unquote, held up best will perform best, while the ones that are most beaten down will probably have a tough job to rebound. Well, if you push that far enough, you might just keep adding money to bonds because bonds have actually outperformed both absolutely and, of course, relative to the market. So you might just say bonds will be the best performers. Well, intuitively, there's no growth there, so that's not going to happen. The second level might be, gee, should we buy more Clorox or something like that, or these biotech companies which have shown a lot of life because they may have some sort of a vaccine for the COVID-19. I would say that you probably want to look for those companies, which include oil, where their demand has been depressed. But when life comes back to normal, whenever that is, that demand will come back. That may include oil stocks as people travel more, people fly around. That could include aviation, a company like Boeing, which makes planes. No one's ordering planes now because no one is flying. But how long will that go on? So a lot of the another great example might be the casinos in Las Vegas. Everyone loves to gamble, but now those casinos are closed. But how long will that go for? Will human nature change so that when the virus eventually runs its course, people won't go back to those casinos in Las Vegas? Those stocks have been very beaten down. Those might be something to look at to actually take advantage of what hopefully is a short-term crisis. Thank you.
We have a number of questions asking about which particular segments investors might look at, which sectors or industries would respond first. So I know you just talked a little bit about that, David, but any more to add there? We do have a couple of questions on that.
Yeah, so we certainly want to stay diversified. We like technology, we like financials, we like consumer staples, we like consumer discretionary. Probably utilities are acting like bonds, and people shouldn't be adding to those because those didn't get sold off so much. So Donna, that's the time for questions. We have limited time here. What we want to do, and what I know you're all waiting for, is to see what the polling looks like here. And let's take a look at that. So we are today, right now, even with the strong market today, up 20,000. And so the question is, are people bullish as to results or kind of bearish? And the bulls have it on this webinar here, with half of you saying that we're going up another 2,000 points from here before year end. We love it. Some naysayers would say, well, that still won't get us to where we were, but 10% is better than not 10%. We had roughly the rest of you divided between up 0 to 10%, down 0 to 10%, and 15% thought we're going to come back down another 10%. So great poll. Thank you for participating. So on behalf of Donna, the whole team at Point View, I want to thank you so much for taking the time to listen to our webinar. We're always open to comments and suggestions. We also have the complete deck of our PowerPoint slides that we'd love to get to you. And if you are in the New Jersey area or you want to call, we'd love to sit down with you for a complimentary meeting to discuss your finances, investments. So with that, Donna, anything I missed? I guess not. Thank you so much. Have a great day.